I'd like us to, if we could, Mike, for the sake of time, just move along to some of the charts that really show how well this works, if we could.
Well, we'll start chronologically with the 2000 top in the S&P, which, by the way, we'll look at the 2000 top in 2008, but if you took those two momentum studies that you'll be seeing and put them together, that's what the top recently looked like. I've had it in my reports to my subscribers, and you could almost overlay these momentum charts on each other. But in the year 2000, the market was up at price level of above 1400, and at the end of 1999. And when we opened January of 2000 at a price of 1469, we broke annual momentum through a structure that is abundantly clear to your eye, but when you look at a price chart at that point, you weren't breaking a thing. In fact, on the price chart at the top of the page, you'll see a red circle. Well, that's where the close of December of 1999 was and the opening of January 2000. Well, at that point, you're basically at the high of the market at that point in time. But if you look at the momentum chart below, you're blowing through a support line that you can define with 5 or 6 structural lows that all line up just perfectly, a very gradual little uptrend line. You just opened right below it. So what happened is you had a pretty bad Jan-Feb, but then you came back up in March and rallied to a new price high. And that seemed to, for a price chart person, that would say, oh gosh, I'm wrong, it's not a top. And I got a lot of laughter from some of my clients because in January I warned this is the top of the market. And when we made a new high in March, there was a sort of, they didn't do it in my face, but I knew it was going on.
I'll relate a story, Mike. I lived through that era very strongly, and in October I felt so strongly that this market was on unstable ground. I literally exited everything I owned, and I had troubles exiting because I was in venture capital and in private equity. So some of them I had difficulties getting out, but I was out. But I got out, and the market then just kept on going up. And as you're saying, through to March, I had people saying, and I had left a lot of money on the table. And I looked bad, I looked stupid, and I felt stupid. But 6 months later, it was like, what a genius move. But but your chart said that you should have felt very comfortable, Gord, that what you did was right. But I didn't. I wish I'd had your charts at the time, Mike.
Yeah. Well, when you made that new high in March, and then later they dropped, and they came back up in August, tried to make a new high again, but basically sort of matched the high in March. But basically, you topped in price in March. So a few months after the annual momentum sell signal, you came back up, and that was your final high, and then you went sideways through August. But all during that time, while price is up there beating its chest at the highs, looking comfy, way away from any major pivotal lows that you could take out or any trend lines that you could draw that were credible. If you looked at the momentum chart, once you broke that structure in January and dropped down, which is a little red circle on the momentum chart in a red arrow, the rally that followed basically confined itself to the underneath side of the violated momentum structure. So if you treated the momentum chart like a price chart and used the normal rules and say, well, if I break this trend line and I get under it, then maybe the trend line will be resistance. Well, it sure enough was. So even though you made the marginal new price high, March, August, so forth, it was all confined like a dog on a leash underneath this red momentum structure that you'd already violated in January. So the market was a dead man walking, and all he was doing between then and the August high was bumping his head on something he couldn't get through, and they finally just gave up. And then momentum started down again, and price followed, and they got in sync with each other. But that's...
and this I was second-guessing myself every single day there, feeling terrible.
Yeah, well, sometimes it's good to back off and not look at days, Sometimes it's important, but sometimes you take days and say, I'm going to see the monthly. But the price difference between the annual sell signal, which was at 1469, and when you really broke price below a credible prior low and broke an uptrend line, was 1240. So, 200-point difference. And a time warning. So you had, if you were running an asset that couldn't be dumped overnight, but you had to have committee meetings and so forth, annual momentum gave you the warning. You had time to reorient yourself to the new reality.
So we moved to the 2008.
Similar situation, very similar. We got to recall then, that's just back when Bernanke was defending the market overtly. When the market had dropped 2 times in the year 2007 to the price of 1370. It did it early in the year based on a collapse. I believe it was the Hong Kong or Shanghai exchange collapsed 10% overnight. So we get sucked down then in the S&P. It was early in the year, made a low at 1370. Came back up in mid-year, May, came back down into an August low. And when we came back down to approach the low of the year, that's when Bernanke came in with guns ablazing. And it was a surprise attack. I think it was an options expiration day even. And he not only cut rates, but he did all kinds of other things like allowed mortgage-backed securities, a certain quality of them at the window, and so more or less froze that market in place by his process of accepting them as collateral. It drove the market to a new high. So in October, you're at a new high above the spring high. Well, at that point in time, annual momentum had not yet broken down. So all that genuflexing by the market, either side of 1500, was lateral action price. It was also lateral on momentum. But when you look at the price chart, you could have plotted a pretty nice uptrend line going back to the bear market low, well, one of the major pivotal lows in 2004. And it connected with 3 or 4 other lows. So you had a good price chart trend line, not a 2-point, but like a 3 or 4-point uptrend line. So it was a valid line. And then you could draw a horizontal line, again, we're talking price, through the 2 lows of 2007, which were at 1370 area. And so you had these 2 lines converging. And by January of 2008, when you opened, remember you opened where you closed 2007, and that was a price of 1468. And when you opened at 1468 in January 2008, you were still almost 100 points above the low of the year that occurred in August. So you had a safe cushion between that and your sell stop on the price chart, and between you and the trend lines that converged there. But on momentum, you opened below the floor that went back like 4 years. So again, a situation when you rotated the year, the moving average changed, you were in the wrong place at the wrong time. The market opened and went immediately down. You went down 200 S&P points pronto. Then came the inevitable rally. And this is the same thing that happened in 2000. It's happening right now. Once you break your momentum, and then next, once you break your price chart pivots, the pivots that an idiot could see with a crayon, the major prior price chart lows, which we did in January. Took out the August low of last year and the October low of 2014. So even the price chart accommodated 200 points lower, but accommodated the break in annual momentum. But as soon as you took out the price lows and ran the stops, the market was, quote, oversold, and so the bulls came rushing in, and lo and behold, you get a huge, a double-digit % rally. The rally is inconsequential to momentum. The price chart people feel it's very consequential because it's so big. In this case, I think we're probably the rally will peter out here in the upper 2000s, 2050 to 2100, not make a new high probably. And that momentum has already spoken, and that this rally is much like the rallies that occurred in, for instance, March through May of 2008, when you rallied 180 points for nothing, just to feel good. And that again occurred after what? After price came down, joined momentum, took out prior price lows, made the picture abundantly clear you're in a bear market, and then they rally anyway. It's just something, it's a fact. You have to live with it. Tops are tough to capture, especially in stocks. I think there's something religious about stocks.
So your views are the February lows and January lows where this has been a bear market rally.
This is, as far as I'm concerned, after we opened January and you got the immediate consequence, you're broken. This is a bear market rally. Now, that's in 2000, the bear market rally made a new high, as we talked about before. You broke structure and went up, but momentum allowed that because the momentum resistance was in new highs for price. This time, momentum resistance, I think, is around 2085, is pretty intense to 2100, which is below last year's high. Which, by the way, we predicted last year's high before they occurred. Momentum in January 2015 said your likely high for the year will be 2130, and that's where we peaked twice. But that was simply by looking at a momentum chart where resistance was. But right now, I think we're in a bear market. This is a bear market rally. Look for it to roll over. But it's also important to not just look at a market. You got to look at things that are tangential to it, that are inverse or coincident with it. And I would look, therefore, at things like gold and its relationship to the S&P. What are commodities doing? How do they look on a relative performance basis versus the S&P? What do these spread relationships look like that have been underway for 3 years? Well, stocks have been going up. Stocks have been beating the emerging markets. They've been beating commodities. But those spread relationships are changing measurably. Just without showing you a spread chart, gold's up 17% on the year. S&P's barely up on the year if it's up at all. I mean, that's 3 months. It's a 17% shift. That shift is quite significant when you put it on a momentum chart of spread. In other words, you measure S&P divided by gold. You plot the difference. You can also run a momentum study on that. So when you look at all these things and put them all together, I see many tectonic shifts are occurring. Not just the drop in stocks, but the upturn in gold.
And you clearly see that we have momentum, an upturn in gold that we broke.
Oh, as far as I'm concerned, it's over with. You broke out in the 1140s to 1160s. This tangling that we're getting into in the mid to upper 1200s is just congestion zone after a very strong surge post the breakout numbers. Again, the breakout numbers are defined by momentum, not price. Many price chartists would look at gold now and say, "Oh, you're up against a channel top, and you're having problems." But momentum says, "No, that channel top is going to be transitory." Why? Because I broke through annual and quarterly momentum in gold, and the power of that is not going to stop at some little price chart reference point.
Yeah, there's a big difference because a lot of the gold bugs really see that it is broken out, but now they're concerned about whether there's a significant retrenchment in here, whether it'll fail, etc. What does oil and the energy sector telling you right now in time?
Well, our view of oil is that, well, first off, it's a lag market. Gold topped in 2011, and clearly we'll see when we get to the gold charts, its annual momentum broke down big time in 2012, while gold was still up there in the 1700 zone. Okay, oil didn't do its collapse, do its version of the contractionary event until August of 2014. So it was much lagged to corn, to wheat, to many commodity markets. It was hanging in upside, hanging comfortably for stock market. And I think that may have been important because gold is not important to the S&P because there are not many gold stocks in the S&P. But oil is, because the oil sector is sizable. So if oil had collapsed, let's say in 2012, it would have damaged severely the ability of the stock market itself to have gone up because the energy sector and other basic commodity stocks would have been imploding. So oil waited until the latter part of 2014, and at that point, the S&P started going sideways. If you look at late 2014, where we are, or where we were, we're there. And so oil held off, but by holding off, it probably held back its need to vomit. And when it did big time. And it broke down. You look at the chart that we've got, it's a fairly simple chart. It's a monthly close only, where all I plot is the closing price of WTI crude futures each month, going back several years prior to that 2014 event. And on the price chart, if you just look at it, you'll see that there's more or less a sideways action. But you could interpret it, if you were a price chartist, as a basing action prior to another leg up. It had the look of the lows were rising more rapidly than the highs. The highs tended to be flatter, and the lows were ascending. So it looked almost like an ascending triangle pattern, pending an upside breakout. And then you came back down in the late summer of 2014, and managed to close below the 3-year moving average, which is plotted on the price chart. And as it happened, that average actually was important, because in the several prior years before 2014, there were a couple pullbacks to that average that held at the average. You would trade below it intra-month, but you wouldn't close a month below it. So when you convert that action, instead of looking at a price chart, which looks fairly neutral to maybe even positive, and you look at the momentum chart, it was clearly a descending pattern with flat lows. So it wasn't a potential ascending upside breakout situation. It was a descending pattern with a floor under it that a blind man could see. So finally, in August of 2014, you managed to close about 15 cents below the 3-year average. It was at just below $96. Well, $96 back then didn't mean anything to a price chart. It was a comfy looking level. You'd been in the 80s before, in the 70s. You were in the middle of nowhere. But for annual momentum, it said, "Oh, I just dropped through the Bombay door." And it was a clear door. It was unequivocal. It was objective. And sure enough, in the next few months, by the end of the year, you'd suffered a massive collapse in oil. In fact, most of the bear market occurred by the end of 2014. What we regard as going on now in oil is that I think you're building a base. It is possible that the low we made just above 26 last month and the month prior might have been the low. I'm not totally comfortable with that. But I think, and the rally we just had to 41.90 last month is a setup for a potential final low. Either one, you're going to roll over again to the mid-30s, which I think you'll do. Last I saw we're 38, 37 after having been 41.90 last month. I think you're going to pull back to the mid-30s at minimum, 34, something like that. And either you're going to hold above those lows, which was, again, just above 26, or you're going to roll over and blow those out. But that'll either be the final, that will be the final low in crude oil. And then I think you're set. When I go not to annual momentum, but I drop down to quarterly momentum, which we've shown, I did it in a report yesterday to our clients, a major pending upside breakout structure. One that, again, if you saw the momentum chart, you would say, wow, I can't believe this thing's this good looking. If the momentum chart of oil that I showed in my report yesterday to clients in the quarterly momentum were the price chart, everybody would be excited by a bottom in oil because you could see the structure ready and waiting to be broken through. But first things first, you got to finish the downside. But once you finish, if you turn back up and you close out any month in the current quarter at 41.20 or higher, which is below last month's high, you've broken out on quarterly momentum. In my opinion, oil's going up to about $60. And I think that could occur maybe by the end of the year.
That's a huge move.
Percent-wise.
Percent-wise, and remembering, as you're saying, there's another down, that whether it's a lower low or how far there goes down, but let me use the word a double bottom, and maybe a lower bottom before we get a very significant move up towards this potentially $60 range. And as you just said, your clients are primarily institutional clients. This is what you're showing your institution.
Registered investment advisors up to major asset managers.
And this is what they're looking at right now in making their assessment. So they're not trying to buy the dip here and catch a falling knife. They're just getting ready to position for that move up. Right? Exactly.
Well, an asset manager can't just turn on a dime usually. I mean, I can because with momentum, it makes me, I don't care about the fundamentals.
But the institutions can't.
Explain themselves later.
The institutions takes time to get consensus within the organization, investment policy group, start to move these portfolios. It's like moving the Titanic in some ways. So they need this kind of lead time. Am I overstating it?
No, I think it's very important. In fact, I get some on the retail end of my client base, high net worth individuals or RIAs who want more close-up timing to trade, and so forth. But you have to understand most of my clients do take some time to think. Then they take my ideas as a second opinion, which is fine, and inculcate and mix those in with their fundamental analysts to see if they can agree or even tend to agree with what I might be saying, and then to start to think in that direction, start looking for reasons that may justify what a MSA is saying. And it gives them a sense of caution at a pregnant point, whether it's a bottom or a top. And usually the markets will give you some time. These things aren't sprung overnight. But once they get sprung, once the whoosh effect occurs, you may not get a second chance at that price level again. And we're getting a second chance this year, because it came back up to unchanged on the year. You get a second chance to short it at optimal levels. Right now, what I'm looking for example, in the S&P is February 12th, when we came off of our low, I put out a report and I warned people, if you're short, you're going to have your profits damaged badly, that we were going to have a big rally. I didn't know exactly where it would go, but I thought it would be damaging enough, so I put out a warning. And I said, beware the meeting. It was a G20 meeting, and I said, this plus some other things tell me there's going to be a big rally. Not a bull market, but a bear market rally could hurt. And so I gave some warning. Now what I'm looking for is I'm not looking at annual momentum anymore because it's already spoken. It says you're dead. You can't offer much more information. You've broken the backbone of the bull market. So what you look at now are lesser time scales. So I'm looking at things like weeklies even. And I'm looking for a downturn that looks credible, that indicates that the rally is over. And what I'm looking at specifically are things like a 3-week moving average oscillator, where you break through structure on it. And then I'll put out a report. My number for next week, for example, is if you close any day in cash S&P at 2042 or lower, you're going down.
Mike, it's amazing how these charts all tell you things. And you just said, that around that G20 meeting, and it was sending you signals, and you're looking at your chart saying, be very, very cautious, as an example. And I just interviewed yesterday James Rickards, who argues very strongly, and he's very knowledgeable on currencies, etc., that there was an accord struck at that G20 that borders on the level of the 1985 Plaza Accord. In quiet meetings, this is his opinion, strong opinion, that there was an agreement struck on what they want to do as when they being the central banks in terms of the yen, the euro, U.S. dollar, and more importantly, the yuan. And we've seen supporting facts that would say that James is right. But what he's saying, and that's on another tape, what you're saying here, is all really ties together. It's amazing how and I guess a lot of people have information that allows them to speculate on it. But your charts support what I'm hearing. I didn't mean to get us off track, but it's just so amazing how it comes together here. We're running out of time here. What does your gold chart say?
Well, the gold chart,
I think it'll support everything we just said.
The gold chart back in 2000, remember 2011 we hit 1920 on gold in the bull market. That was in August-September period. And at that point in time, bulls were very comfy with the idea that what was going on in gold was a congestion zone. And in fact, for the next year, it waffled sideways, getting into the 1500s, going back up into the high 1700s, but basically a sideways, steady tone. And they could rationalize that this is the next leg for the upside. After all, the QEs were continuing. Why shouldn't it continue up? The problem was in January, if you look at the price chart at the top of the page, you had the sharp drop from late 2011 into a low in January of 2012. But when you came down in January and broke through the price of 1650, it didn't do any damage to price chart, but it blew an uptrend line on the annual momentum chart, and it also took out a major prior pivotal low on the oscillator on gold. So in other words, if you have a sequence of higher lows in a bull market in price, that didn't violate anything, that sell-off on the price chart. But on the momentum chart, it not only broke an uptrend, but it took out the major prior low, so you did double damage. It was a warning. It says you're topped. Now, after that, there was an excruciating amount of time where price didn't break down. It oscillated, mostly below that 1650 level, actually. So if you actually got short at 1650, you were out maybe $100 or something at the worst point, and ahead 100 plus at the best point in that range. But finally, in early 2013, momentum took its next step down in a decaying pattern. And if you contrast what momentum looked like coming into 2013 versus price, you'd say, gee, momentum's already in a deep bear market, and price joined it. And so suddenly, the whoosh effect in gold came between April, May, and June of 2013. You went from the almost 1700s down to under 1200 in a whoosh. And there was your bear market. There was the great discounting of what had been pent up in the damage done by annual momentum. Gold finally paid dues. And ever since the summer lows in 2013 at 1178, I think was the low, you've oscillated downward gently, but you've oscillated back above that level repeatedly. So that level was sort of a midpoint. We're above that level now, for example, in the 1178 area. But during that decline in gold from that summer low of 2013, you have a staircasing downside pattern. So every turn around, you get a rally, it fails. Doesn't make a new high. Come back down, make a new low. Make a lower high, lower low. It's a bear trend. Most people were looking for a collapse to 1,000. I think even Goldman Sachs and a lot of gold bulls. Of course, if you went to 1,000, you weren't going to stop there. It's a round number. You'd probably go to 900 or something. We weren't. I kept coming up with numbers that said, no, you've lost that opportunity. If you were going to do that, you should have done it a lot earlier. And if you look at the momentum chart, you get a totally different picture of the action since that 2013 low. You get horizontal action, totally basing action. If the bottom chart were a price chart, you would not be hesitant in saying, hey, this looks like a bottoming pattern. Price didn't look that way, momentum did. Well, the point at which momentum broke through the top of that base, which occurred in the second week of February, was when price emerged up through 1140 to 1160, a level well below the current market. And the first surge took us up to 1260 and finally up to 1280. So I think gold is broken out on annual and quarterly momentum. I don't show the quarterly chart here. The quarterly chart looks very much like this. I think gold has paid its dues. It's turned, and I'm getting secondary evidence from other markets, specifically foreign exchange. The yen has turned positive in our view at the end of last year at 83. Yen futures I'm talking about, they're now trading up at the 89.90 level.
And this supports what James Rickards' Plaza Accord suggests too. He believes
Right,
there's
right.
strength in the yen,
Yeah.
and there'll be strength in the euro, which countered at what you're thinking, because that really relates to a weakness in the U.S. dollar. But most importantly, it allows them to lower the value of the yuan in a stealth manner without forcing the yuan down. It's all relative. And
That's
that was
correct.
the agreement he believes was struck. And that's what they're working on. On all the charts, they're starting to send that signal.
I agree. I think the euro is the
And
key.
by the way, he's recommending gold strongly in his new book
Absolutely.
because he says it's the place to be now, today, not last year, now.
Now, well, that's good. It makes fundamental sense now too, but the price at which we've got bullish, major bullish, was 1140 to 1160. Everything that's going on since then, the noise in the mid 1200s is noise. It's part of an uptrend. It's a congestion zone. I happen to think that our first major hurdle for gold, a major hurdle that could get you a decent correction, is probably 1450. You might see that this year. I happen to think also that in measuring other things is that actually it's time now to be long gold stocks more than gold. The GDX, for example, which is unleveraged ETF of gold miners, is up vastly more than gold this year and will be up vastly more than gold on a percent basis if gold ever gets to 1450. I think the GDX will be in the upper 30s. And from its low down around 12 or 13, that's a move.
Final observation, Mike, comment on silver, because with the gold-silver ratio saying silver is incredibly cheap on any historical measure in terms of the gold-silver ratio. Comment, any sense there?
Yeah, I've plotted that recently in a recent report, and that is not yet broken fully, where the number of ounces of silver to buy an ounce of gold got up into the 70s, and I think my number, as I recall, was 71 or 70 area. If you ever get it down to that level, where the number of ounces of silver to buy an ounce of gold drops down to 70, there is a structure, both visible on the spread chart of silver versus gold and the momentum of that spread, that says, okay, you've turned it. At which point, at that point in time, and we'll update in MSA reports on this, silver will also be a better place to be than gold. Silver's probably suffering a bit because of its industrial side. Although that could be a positive for it, because we all know that copper, as long as it's been beleaguered, and it has the potential to rally sharply too, by the way, it's got some structures. But the beating up of copper, to the extent that that might restrain copper production, or lead or zinc production, is bullish for silver, because that's where silver comes from.
And you've seen some turn in iron ore, I believe, also,
It's a turn in iron ore.
which is sending some pretty clear signals.
What we're getting is across the board, in pieces, some lag, some leading. Oil, gold leading, oil is lagging. The pending upturns in a major commodity upturn. Now, I'm not going to say it's going to be a 1980 event, 77 through 78, where commodities all went crazy on the upside. I think this is more monetary, and gold will therefore should be your focal point, or gold-related, gold miners. But I think these other commodities are going to participate, and if oil gets in there, and natural gas looks just like oil on structures, if those get in there and engage on the upside, even if it just fails at 60 on oil, and then rolls back into the 40s again, I don't think oil will make a new low after that, but you go from a 26 low and you go to 60, you're going to have big problems up there. But that alone is a huge percent move, and most commodities have similar percentage moves pending, where I can look at their charts, their momentum, and say, if you break out, you're going to go X amount, likely before next resistance. The problem with that is it takes the 2% objective of all these central banks and blows it out the roof. And they're going to be shocked by the commodity upside, the upturn and the commodity effect on their various inflation metrics, such that I think it's going to disturb the long end of the debt market. And I mean the safe long-term end, the U.S. government and the German Bund yields, which are very low. I think it's going to change the yield curve spreads, where the 30 versus the 5 has come down, and the 10 versus the 2. I think these things are going to expand back to the upside more normally. I think that the Italian versus German yield spreads, which have converged to, historically abnormal, insane lows, where Italian debt doesn't yield much more than, that will change. Again, disfavoring Italy, disfavoring Spain, disfavoring France. So a lot of these things will come undone. And of course, these things we're talking about are things that were put in place by central banks as part of their policy. So if commodities have this surge, some of which will be bear market rallies, some of which will be actual bull markets like gold, the upside in that taken collectively could do a lot of damage. Plus it'll have the dollar as the wind at its back, with the dollar weakening. Have a lot of damage to the assumptions of the central banks and could cause an unraveling of all of their little objectives. It could happen rapidly.
That would be pretty devastating to the equity markets, would it not?
I would think so. So we've got the situation where people think if oil upticks, it helps the S&P. That's been the game for months now. I'm telling you, if oil upticks the way I think it could, if you break through that 41.20 monthly close anytime, any month this quarter, the upticks you're going to see won't be pleasant for the S&P because it won't be pleasant for the debt markets. And therefore, it will be the opposite of the common wisdom today.
Mike, we went on longer than we usually do, but I personally really enjoyed this very much, and I hope our listeners, I wanted them to get a true understanding of the work that you're doing, the perspective that the institutions have, your clients have, of how they look at things. Many, not all, maybe some of the smarter ones, shall I say. Any closing comments that you'd like to make with our listeners, terms, and then also how they can learn more about your work?
Oh, well, of course, the website to go to is Oliver MSA. That's Momentum Structural Analysis. So olivermsa.com. And there's a visual tour of the methodology, PowerPoint. Takes about 7 minutes. There's the press clippings, of course, and then there's some for background. And so you'll get informed on basically, you got it mostly today, but you can get refreshed there. And there's a mode of subscribing there and so forth. But you'll get a history of the MSA and our methodology. And we also encourage you to ask for sample reports. We're happy to send some along. We've had a lot of market calls that a lot of people didn't make, like the Shanghai explosion from 2014, where it went from 2,100 to 5,100. We call the top in the Shanghai. And so a lot of markets that we didn't talk about today, we look at everything. We're not just narrow to stocks or commodities. We look at Forex and debt markets as well.
I think that's one of the most impressive things I've seen in following your work, not only your calls, not only your charts, but your cross-sector where you go from commodities, bonds, yields, stocks, and you draw perspectives. And your perspectives that you see that the charts are telling you, I find very, very enlightening and very valuable. So I compliment you on that. Mike, we're going to have you back and revisit some of these calls and some of the newer ones, because I really think that it's going to be a pretty exciting 2016. And if you're invested properly, there's a lot of money to be made. If you're not, you're going to lose a lot.
Well, the Wall Street Journal quoted me in the Christmas issue, the holiday between Christmas and Christmas holiday weekend, and they loved a quote they saw in one of my articles. It said, "Lock and load."
Yes, that's the feeling I've got. Get strapped down, because it's going to be a ride. That's for sure. Mike, we have to run. Thank you very much for the time, and we'll talk to you again. Bye-bye.